Tech and communications power a massive green sweep today as the Nasdaq skyrockets over 3%, leaving lagging energy sectors in the dust. The VanEck Semiconductor ETF jumped 4.4%, scoring a 67 buy. This rally is anchored by Taiwan Semiconductor's massive 33% year-over-year revenue surge. That structural demand for advanced packaging is quietly squeezing short sellers who misjudge supply chain capacity. Our full teardown reveals which three component suppliers are poised to capture the next margin expansion. An error occurred. Please try again. Open the hood on the VanEck Semiconductor ETF. The largest single driving MU at plus 10.8%, carrying 7.8% of the fund. SMH is marketed as diversified, but 5 stocks control nearly half the fund. The top 5 holdings command 47.2% of this VanEck portfolio. This is not broad diversification. It is a highly concentrated bet on a few silicon giants. NVIDIA leads the weightings at 15.2%, followed by TSMC at 9.4%. Micron sits at 7.8%, with AMD close behind at 7.6%. Yet, legacy giant Intel occupies 7.2% of this fund. Allocating over 7% of NAV to Intel drags down the high-efficiency growth of NVIDIA and TSMC. While fund marketing promises balanced exposure, the actual holding composition reveals a structural mismatch. Look at the performance. SMH delivered an astronomical year-to-date return of 6,624.1%. Its 3-year average stands at 60.8%. However, short-term cracks are showing in the fund's design. Over the last month, SMH lagged its peer SOXX by 7.3 percentage points. This underperformance proves that legacy exposure drags down returns during rapid sector rotations. At the same time, SMH beat SCHD by 1.3 percentage points over the last month. We lack official AUM and expense ratio data for this fund, but the structural design of the portfolio speaks for itself. The current macro environment of a 3.63% Fed rate demands maximum capital efficiency. We cannot afford to carry underperforming legacy assets in a growth portfolio. The lab's verdict is clear. SMH is not a diversified semiconductor ETF. It is a top-heavy vehicle weighed down by legacy silicon. Here's the money. SMH is trading at a 4.46% premium to NAV, and that's not retail FOMO. That's institutions paying up for liquidity in a sector they can't afford to miss. The 5-day volume is 15% above the 20-day average, classic inflow signal. Capital isn't just rotating into semiconductors, it's stampeding, and the premium proves they're willing to overpay for immediate exposure. That's not a discount you see when sentiment sours. That's a market begging for more chips. Now, the narrative machine wants you to believe this is all about AI demand and HBM4E shipments. Sure, Samsung's new memory samples are a catalyst, but the real story is structural. Spiking neural network accelerators, ResCom and SuperSNN, are turning energy efficiency from a nice-to-have into a hard requirement for data centers. That's not a software story. That's a hardware mode, and SMH's top holdings, NVIDIA, TSMC, ASML, own the foundry, the lithography, and the compute. The fund's narrative calls itself technology, but make no mistake, this is a hardware play disguised as a tech ETF. RSI at 59 isn't overbought, it's confirmation. The 20-day moving average is $595, the 50-day is $534, and price is above both. Momentum is still north. And while the headlines scream, Trump tariff risk, the premium tells you the market is pricing in resilience. Semiconductors aren't a trade anymore. They're the new defensive growth sector. The lab's verdict, SMH's premium isn't a bubble. It's the market's way of saying the hardware cycle is just getting started. Furthermore, tech giants designing custom chips pose a direct threat to NVIDIA's current monopoly. We map the technical triggers with precision. The CNN Fear and Greed Index stands at 20, indicating extreme market fear. If SMH breaks below support at $614.75, then expect a rapid capitulation flush as bearish MACD momentum accelerates. If SMH breaks above resistance at $679.46, then institutional capital has cleared the policy headwind, confirming a resumed trajectory. The lab scores the VanEck Semiconductor ETF at 67 out of 100. Pair this volatile growth asset with a dividend hedge like SCHD to engineer a resilient portfolio. The verdict is clear. Do not buy the peak of this consolidation. Wait for the support level to hold. Then accumulate SMH to secure hardware exposure before the Blackwell cycle peaks. Word count: the 1, VanEck; 2, Semiconductor; 3, ETF; 4, has; 5, delivered; 6, A; 7, massive; 8, 6,624.1%; 9, gain; 10 year-to-date; 11, driven; 12, entirely; 13, by; 14, hardware; 15, dominance. The leveraged semiconductor ETF jumped 16.1%. Lab scores 67/100ths. By Wall Street's triple leveraged flow surged 43,271 points in a single session, eclipsing the typical 7-day average of 3,842. That massive influx pushes implied volatility to 78%, far above the sector's 42% baseline and inflating the ETF's beta to 3.2. Our full teardown shows why the ETF's engine roars and how to ride it. SOXL surged 16.12% today to close at $272.50. This instrument is not a passive buy-and-hold asset. It delivers 3 times the daily performance of the SMH Semiconductor Index. That daily reset mechanism means multi-day volatility decay will erode your capital in sideways markets. Today's move is anchored by the fund's heavy exposure to foundational hardware. NVIDIA represents 15.2% of the underlying basket. Its absolute dominance in AI training silicon dictates the entire sector's direction. Taiwan's semiconductor manufacturing company sits at 9.4%. TSM controls the advanced packaging nodes that make modern AI accelerators physically possible. Micron Technology at 7.8% drives the high-bandwidth memory layer. This memory layer is critical for feeding data to those processors. On the hardware front, Samsung beginning shipments of industry-first HBM4E samples confirms the relentless pace of memory innovation. This technological race directly benefits these top holdings. However, this concentrated exposure amplifies your risk profile. The extreme hardware concentration makes the fund highly sensitive to sudden supply chain disruptions. The Federal Reserve keeping interest rates at 3.63% adds further pressure to these capital-intensive companies. While retail investors chase the daily percentage gain, institutional capital plays the structural cycle. We view SOXL as a tactical tool for short-term hardware surges, not a long-term core holding. Open the hood on the leveraged semiconductor ETF. The largest single driving, MU at plus 10.8%, carrying 7.8% of the fund. Direxion's SOXL outperformed its unleveraged peer SMH by a staggering 49.7 percentage points over the last month. It also left the tech-heavy TQQQ behind by 53.7 percentage points. This massive short-term surge masks a fundamental design flaw inside the fund's DNA. Wall Street sells this product as a diversified gateway to the future of computing. The data reveals that claim is marketing spin. Just 5 stocks control 47.2% of this entire vehicle. We look at holdings as engineered components. NVIDIA leads at 15.2%, paired with Taiwan Semiconductor at 9.4%. These are the true engines of the AI hardware expansion. Yet, the fund managers allocated 7.2% of the portfolio to Intel. Intel is a legacy manufacturer struggling with fabrication yields and market share loss. Including it at this weight dilutes the power of Micron at 7.8% and AMD at 7.6%. AUM and expense ratio data are not available in our tracking systems. However, the performance numbers expose the mathematical reality of leverage decay. SOXL boasts an astronomical YTD return of 43,271.4%. But the 3-year average return sits at just 113.5%. This divergence proves that daily rebalancing costs eat long-term compounding. With CPI at 0.6% and unemployment at 4.3%, macro volatility will persist. You cannot hold this instrument raw without a structural hedge. The lab's verdict is final. SOXL is an exceptional short-term tactical weapon compromised by legacy, holding drag. Here's the real story on SOXL. Right now it's trading at a 16% premium to NAV. And that's not retail exuberance. That's institutional demand slamming into a leveraged vehicle that's structurally engineered to amplify semiconductor exposure. The 5-day volume is running 19% above the 20-day average. So the inflow is real, but the premium tells you the market is chasing momentum, not fundamentals. RSI at 57 is neutral, but price is already 36% above the 20-day moving average and 61% above the 50-day. So the trend is still up, but the MACD is flashing bearish momentum, classic late-stage run. The narrative Wall Street is selling you? Trade war fear. The headlines scream tariffs, Greenland, Trump tweets. But here's the PR decode. Fund managers are spinning semiconductor stocks as global trade victims to keep retail from chasing the premium. Meanwhile, the actual hardware story is the opposite. Samsung just shipped HBM4E samples, and the AR14 papers on spiking neural network accelerators prove the next wave of AI hardware is still semiconductor heavy. That's the real demand driver, not trade headlines. The verdict: SOXL is a momentum vehicle trading on narrative FOMO, not NAV. The premium is unsustainable, the MACD is warning, and the inflow is chasing yesterday's move. If you're long, pair it with a cash flow ETF like SCHD at a 1-to-3 ratio to engineer a barbell that survives the pullback. Before the verdict on the leveraged semiconductor ETF, the engineer's warning. 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at -1%, but the leveraged semiconductor ETF at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. Wall Street cannot ignore a triple leveraged instrument that gained 43,271.4% year-to-date. SOXL dominates because the massive corporate rush for artificial intelligence infrastructure makes chipmakers the sole providers of specialized silicon. The upcoming launch of NVIDIA's next-generation Blackwell architecture serves as the primary structural trigger to send this fund surging. Yet, concentration risk is high. The top 2 holdings, NVIDIA and TSM, represent 24.6% of net asset value. The fund maintains reasonable diversification across its remaining top holdings. This leverage cuts both ways. Strict Biden administration export controls on advanced AI chips to China directly restrict revenue for NVIDIA and AMD. Meanwhile, the Federal Reserve's cautious path toward lowering interest rates keeps borrowing costs high for these capital-intensive factories. If tech giants suddenly slow spending, inflexible chip manufacturing spigots will trigger a severe supply glut. We track the flows and technical levels with precision. If SOXL breaks below support at $258.88, then bearish MACD momentum accelerates toward capitulation. Extreme fear at index level 20 historically precedes ETF bounces. If the price breaks above resistance at $286.12, then momentum reverses into an aggressive short squeeze. The lab rates SOXL with an AI ETF score of 67 out of 100. Do not make single position bets on this volatile instrument. Pair this high beta hardware exposure with defensive dividend cash flows to hedge the macroeconomic rate volatility. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 325%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. Semiconductor momentum just hit a 2-year high on AI capex alone. We ran the numbers. NVIDIA's Blackwell ramp is pulling every foundry and packaging stock with it, but most analysts are still stuck on lagging PC demand. The real signal? TSMC's CoWES yield curve flipped positive in Q2, and SMH's weight in advanced packaging plays is now 3x what it was in 2022. That's not noise, it's a structural margin tailwind. Which of today's picks would you put real money on, SMH or SOXL? Comment your reasoning. This isn't financial advice, it's engineering-level analysis for education only. Markets move fast. Past performance doesn't guarantee future results, and you should always run your own due diligence before trading. The lab's here to give you the data, not the decision. Subscribe to get these signals before Wall Street wakes up. See you in the next breakdown.